A vehicle is likely the second largest purchase you'll ever make. For decades, the rule was simple. The moment you drive that new car off the dealer lot, you immediately lose money. This graph shows that traditional reality, a standard car losing about 55% of its value over 5 years. But the current market has fractured that single decline into 3 distinct financial paths. First, we have high-retention vehicles. Models like the Toyota Tacoma maintain up to 63% of their value over that same timeline, drastically slowing your loss of capital. Second, you see these sudden upward spikes. This represents active labor, someone buying a high-demand commuter car and forcing a quick profit in a matter of days. Finally, we see wild, longer-term swings. That is the speculative market, where classic vehicles like an 80s Porsche can jump 21% in a single year. The danger comes from mixing these paths up. If you treat a standard daily commuter like a financial investment, you end up overspending on hype. You bleed capital to hidden costs like loan interest and insurance premiums, waiting for a return that will never arrive. Avoiding massive financial losses requires abandoning a one-size-fits-all approach. You have to strategically match your vehicle to your specific financial goals, your free time, and your risk tolerance. The first path belongs to the passive optimizer. This is a driver seeking reliable transportation with the absolute minimum financial bleed over a 5-year cycle. The strategy is straightforward. Purchase a class-leading resale vehicle. A truck like the Toyota Tacoma acts as a direct hedge against normal depreciation. This logic applies to the EV market as well. For lifestyle buyers, models like the Rivian R1S lead electric vehicle retention, holding on to more than 70% of their value after 2 years. By selecting vehicles with these specific retention metrics, you recoup significantly more money in trade-in, often an extra $4,000 or more after 5 years, compared to an average car. There is a trade-off. Passive optimizers frequently use instant buying services to save time when they sell. You skip the hassle, but you forfeit the 10 to 20% price premium you would get from a private party buyer. The passive optimizer accepts locking up higher initial capital upfront. That is the necessary cost for zero ongoing labor and predictable capped depreciation. The second path is the active side hustler. Here, you leverage low capital and heavy sweat equity to generate fast profit. You start by buying budget vehicles with massive demand, usually between $3,000 and $5,000. You take a car like an older Honda Civic, apply some minor cosmetic detailing, and relist it. Or you target the reliable appliance flip, like a silver Toyota Corolla. Because these cars have incredibly broad buyer demand, your resale price is highly predictable. Execute the detailing and take clean photos, and you can force a $1,000 to $2,000 profit margin within a single week of listing. As you build a bankroll, you can scale up to mid-range targets like 4x4s. An older Jeep Cherokee XJ ties up more cash, but it pushes your per-unit profit to between $2,000 and $5,000. The trade-offs are severe. A single bad mechanical read can wipe out your entire working capital. Furthermore, turning cars quickly hits legal dealer license limits. Depending on your state, selling more than 3 to 12 vehicles a year without a license results in steep fines. On this path, your capital is strictly ammunition. The actual product you are selling is the time you spend monitoring listings and turning wrenches. The third path belongs to the speculative collector. This profile parks cash in tangible assets, looking for long-term appreciation. The strategy involves buying discontinued icons from the 80s and 90s. Vehicles like the classic Porsche 930 have recently shown the potential to appreciate by over 20% annually. At the absolute high end of this market, specific 80s poster cars command massive, multi-million-dollar premiums from buyers chasing nostalgia. The primary risk here is total exposure to macroeconomic factors. Your asset's value relies heavily on shifting interest rates and auction supply gluts. The data bears this out. Global collector car prices actually fell 10.2%. If you answer yes to having the time to wrench in detail, you follow this path directly to the flipper strategy. But taking this route without actual mechanical knowledge means you risk buying a car with a fatal defect, like a blown head gasket. Paying a professional shop to fix a mistake like that will wipe out 6 months of your hard-earned profit. If you don't have time to wrench, you move down the no path to the next essential question. Do you need reliable daily transportation? If you do, Stick to the optimizer path. Buy a high-retention vehicle like a Tacoma, CR-V, or Lexus RX, and accept passive depreciation as the unavoidable cost of living. If you don't need a daily driver and want an alternative investment, take the collector path only if it is primarily a passion project. The market is too volatile to rely on. If you are actively seeking cash and choose the flipper path, stick rigidly to specific economy models where parts are cheap and demand is infinite. Navigating the 2026 automotive market successfully requires aligning your vehicle purchase with your true risk tolerance. Ultimately, it determines whether your car works for you or whether you end up working for your car.